make of the moves today? Is this something that is going to be a longer-term trim, just a blip on the radar because of the pace at which yields rose over the last two sessions?
Yeah, I mean, I think yields are definitely going to be a challenge to the stock market this quarter. Remember, the two most important factors in stock prices are earnings and the interest rate. And now the earnings this year was fantastic, but you want to know the truth? The good news is out. In fact, when I look at forward-looking earnings estimates, they're stable, even slightly declining. So all that great news on earnings is basically in the market. And now this sudden move upward in yields, you know, I mean, that's the denominator of what we capitalize these earnings on. And if the denominator is going to be strong, that's going to be a challenge. You know, late last year I said, you know, I was always asked, what do you think 2018 will be? I said 0 to 10%. Well, we just about got to that 10%. We did. And I said yields were going to be a challenge. I thought it was going to come a little earlier, but on maybe this quarter that we're going to see the impact.
So, Professor, are you saying there that we're now going to see a pullback for the rest of the year in equity markets, or just a plateau?
Well, a plateau or a slight pullback. I mean, don't forget, I mean, even before the strong economic news we've gotten the last few days, 12 out of the 16 FOMC members said we're going to hike again in December, and the Fed said it's going to hike 3 more times next year. So, I mean, that trajectory looks very, very strong. If the 10-year is going to be, you know, also moving up along with those rates, it seems to me hard for the stock market to make a lot of progress. What is the good news? Maybe, you know, if they make a deal on China before year end, that'll give you some pop. But other than that, I don't see what could drive stocks markedly higher this quarter.
Professor, tomorrow we're going to get the jobs report. I mean, how important is wage growth going to be this time around? Earlier in the year, it was something that really tripped us up in the markets. We want to see it, of course, but what does that mean for equities? What are your expectations for tomorrow?
Yeah, wage growth driven by productivity growth is very good, but wage growth that's driven by drum-tight labor markets is a problem. And the unemployment rate then becomes a problem as that keeps on, you know, heading down to multi-decade lows. Yes, tomorrow's important, but remember there's also going to be a November and December report before the Fed meets in its December meeting. So there's still certainly a lot more data that's going to come, but all of these early in a business cycle, strong economic news is great for stocks. There's a lot of slack in the economy. Higher interest rates don't matter. Late in an economic cycle, when you have drum-tight labor markets and you get a big push on demand, that becomes a problem for interest rates and a problem for the stock market. This is really pretty classical on how the business cycle works.
Yeah, which I guess Professor Siegel brings really the big open question as to exactly how late we are in this cycle. You look at all the leading indicators of recession, none of them seem to be flaring up right now. So if you have a long runway for the economy before you have a steep downturn, and most bear markets don't really happen unless you have a recession, where does that leave the stock market? Just being kind of less generous and more choppy along the way?
Well, you're right. We don't have any immediate indicators of a recession. And by the way, this big jump in the 10-year goes against the inversion of the yield curve. You could argue, actually, the jump in the 10-year would make the Fed more aggressive because they're not worrying about inverting the curve. And usually, once you flatten the curve, you still have 6 to 12 months before a recession really begins. So some people can argue this is a delay. I look at that unemployment rate. You know, it's supposed to tick down to 3.8, and, you know, look at the ADP number that we got yesterday. I mean, the population and demographics is giving us 100,000 at most a month. If we're going to be 200 to 250 driving jobs, unless we can tease out something on that participation rate, which I hope for, but it's hope against hope, we're going to keep on lowering unemployment. And, you know, look at historical charts. If we ever hit 3.5%, that has always unleashed wage inflation. We're at 3.839 now. So these are the factors the Fed is going to be looking at, and I think these are the factors that are going to be worrying stock investors in this quarter.